Basically, we have a grossly weakened economy and financial system. And not only do we have a grossly weakened economy and financial system, the policy options left to the government are very few, and they're not very powerful. Did catch Paul Ryan on the way over here, and he was basically rejecting what Obama put forth, I guess, last Thursday. And basically, they're off the mark. And we don't have many possibilities left. Let's put it this way. We have very little ammunition left, and it has to be targeted to the biggest payoff. And we're not doing that yet. We're not defining the issues yet to the point where our little ammunition can get directed as best as possible. How we got here are, what I'm going to do is list what I call 3 major drags on the economy. They're all long-term. And then as a result of those 3 major drags, there's about 5 or 6 collateral damage areas that I just want to address briefly and then go on. How we got here, most fundamentally, which is probably least observed or understood, is the competition, the unleashing of the competition from the less developed countries who became emerging market countries, who are now being called developing countries, i.e. the Chinas, the Brazils, et cetera. It was about 22 to 25, maybe as far back almost as 30 years ago. Basically, they learned how to shed their status of a less developed country. Very low levels of income, very low levels of employment, high levels of unemployment. Wages were dirt cheap compared to the United States and the developed world. So basically, their job was to get capital, i.e. physical capital, to locate manufacturing facilities in their countries and then be able to use the very inexpensive labor. On top of that, they had inexpensive government overhead. They don't have entitlements. They don't have regulation to the extent we have. They don't have taxes to the extent we have. And then the other part of their construction as export powerhouses was to get rid of the tariffs. And they successfully did that through treaties and the WTO. So basically, they got on their feet, and it's been a battle ever since for U.S. manufacturers and the manufacturers of the entire developed world, which includes Europe and Japan and the United States. All of the countries that 25 years ago, 20 years ago were up here in terms of per capita income, and they were down there. Well, we're moving toward convergence rather quickly. The game is not over. I think there's probably another 5 to 10 years. And probably after 10 years, we're going to be able to hold our own. And the reason we're going to be able to possibly hold our own is the unfortunate reason is wages in the United States are declining. And ours are declining, which are a problem now, but we're getting competitive with all things considered, maybe more productive manufacturing, et cetera. But I think we only have another 5 to 10 years to the point where we can start holding our own. Even China, believe it or not, with their excess capacity of labor, also has a demographic problem because so much of that labor is elderly because they've had since the 1970s, 1 child per family. So their demographic is elderly like the United States. So at some point, they're going to also run out of cheap labor as well. And that's probably the next 5, 10 years. So this thing has been going on, as I say, for more than 20 years. It's systematically weakening us. We've lost our manufacturing base, probably 90% of it. And wage rates have gone down as a result. And just to give you an idea of what that looks like, this is the wage income relative to GDP in the United States. In other words, how much of our income is derived from wages. And this is a tragedy. The 1960s, we were like at 54%. This is the tech boom, so there's a little bit of an interruption of the trend, but our wage income derived in the United States from wages is down to 44%, and it was at 53%. So that's how it's affected us, and it continues to affect us. The second major cause of where we are of a weakened economy, doing this chronologically, is a little bit more recent, and that is 2003 to 2007. I've spoken to this group about it before, which is the capital inflow surge from the emerging nations into mortgages and residential mortgage-backed securities, which financed the housing boom in the United States. And it's about 4 years ago last month when it all came to a head, where we overbuilt houses and we overfinanced the consumer sector. We raised the debt to income ratio enormously, and then we woke up one day and they overbuilt, and when you overbuild, you leave yourself in a situation where the biggest asset on the balance sheet of the consumer has now deteriorated probably 30–35% in value. And the next bad news is housing prices are going back down again. They flipped up a little bit, but now they're heading back down once again. So what that does to the consumer, it does a few things. That overdose of houses that don't go away unless you dismantle them, and they're actually beginning to. Bank of America is beginning to. But you have this excess supply of housing, which means the price declines, and the consumer is left in an upside down position because his debt doesn't decline, but his asset does, so his net worth melts. And and not only, that's the first part. The second part is the housing industry. The house building industry was about 2 to 3% of GDP, and that's basically down to 20% of where it was. So we're losing a couple points of spending in that direction. The other place we're losing spending is the consumer's trying to deleverage his debt, and he's in a situation where his asset has fallen below the value of his debt, and of course we're going through the process of walking away and foreclosure, et cetera. What it does is it causes the consumer to rein in spending, and that has not in any way been successfully addressed by the administration. I think they're back at it again, but they're still not. The only way you get to get rid of that is to get rid of the principal. And the good news is the interest rates are so low you can refinance, so the cash flow burdens are reduced. But they have to get rid of the debt side of the balance sheet. The other thing that would help is of course, to demolish a bunch of houses. I'll get to that a little later, but we only have excess 3 million houses, and that's not really that large a number. And the federal government would have to buy them and demolish them. It's probably about a $400 billion price tag, which is less than Obama's package from last week. It would simultaneously not only resurrect the balance sheet of the consumer, but on the other side of the transaction is the lender. Not only is the borrower upside down because of the debt, but those who did the lending, which are the commercial banks and other financial institutions, because the servicing of the debt is problematic and the collateral behind the debt has been reduced in value. So basically the asset side of the lender has also diminished. So they're upside down as well. The upside down parties are the U.S. financial institutions, unfortunately also foreign financial institutions who bought into it. So the housing problem is not going away. And you might think after 4 years that it would go away. We had really an excess, almost 3 million houses. The annual production, I think, per year was almost 2, was it? I think 2 million a year, about that, Ed? Something like that. So you'd think in a 4-year period it would go away, but it's not going away. The reason being is that in these tough economic times, the households are shrinking because they're moving in together. They're consolidating families, they're consolidating roommates, and so basically the demand for housing has slipped along and the supply still sits out there. So basically we're not making any progress. Still the excess houses are about where we were 4 years ago when the whole thing began. And that's why the housing prices continue to slip. That's why the consumer's balance sheet is upside down, and that's why the lender's balance sheet is upside down, which then has all kinds of additional effects, which is they don't lend because they know that they're upside down and they're trying to build up their reserves for the day of reckoning, whenever that comes. Okay, the third major issue in front of us that we can't get rid of is something called demographics, probably most generally, and that is the baby boomer population percentage. It's 30% of the U.S. population. And in the next 18 years, actually we're 6 months into that, where the baby boomers have hit, quote, 65. So we have 17 and a half more years when they hit the start of their retirement, and then if their expected life is another 20 years. So basically we have, by the way, the baby boomer generation is over the next 18 years. And then you give them another 20, so we're talking 40 years, we're talking 4 decades. So we have 4 decades of a situation where we have entitlements promised to the baby boomers, which are going to be an enormous fiscal drag. And I think ultimately we'll get into some kind of fiscal reckoning with the United States because it really can't be handled. And later I'll tell you how bad it is. Well, I'll tell you about it right now. Now that I'm on the subject. The aggregate numbers don't compute with you and I because it's in trillions. And if you do the present value of the contingent obligation that are unfunded, the present value of the unfunded contingent liabilities is about 60 trillion. Currently, our debt is 15 trillion. So that means we get from 15 to 75 trillion of debt, and the income stream is less than 15. And it's not going to grow very fast because the other side of the implication of the demographics is that our labor force won't be able to grow more than about 1 3/4% a year, where in the entire post-war period we've been growing at 3% a year. So labor ends up being a constraint and slows your growth down. One way to get around it is go to immigration, and we're not presently doing that. But the point is, the demographics hit two ways. It slows down the supply side capacity of the growth of the economy, the generation of income. At the same time, we have this big bill to be paid. Now, throwing out $61 billion really doesn't mean a whole lot to you or I or a congressman, but let me put it in other terms that does make sense to you and I. If you take the same number, the present value of the contingent obligations to the unfunded, to the baby boomer generation, and you calculate it on a per capita basis of every taxpayer, and it's $130,000 per person, which means a family of 4 was promised about $1.4 million by the U.S. government. Okay, I hope that brings it home. It should bring it home. The government has promised every family of 4 $1.4 million of entitlements. Where are we going to get it from? We have no idea. But the point is, we have been operating, and people have been operating on the assumption that when they get the golden handshake and the watch and they're retired, that they would be receiving $1.3 million of entitlements from the government, and basically their savings rate has been very muted because they thought they were getting this government bailout. So we have a situation, just to put it in terms we can understand, 1.3 million promised to every family for which we have no funding, a family of 4. And where we're going to get it, it will become problematic as I go on. But that's the dimension of the problem. So demographics are hurting us badly. Now, as a result of those 3 major causes, we have lots of collateral damage.